Hello, everyone. Greg Towner here with Parallel Portfolios, and it is time for our next 5 charts in 5 minutes. This one for November. So let's jump right in and get started. So we, of course, like to start off taking a look at the 3-year chart of the S&P 500 stock market. Instead of focusing back on this left side, let's focus in here on the right. We know that the late summer, early fall period here tended to have more of that seasonal weakness that has become common over the years. But lo and behold, the market found a bottom. It's rallied here sharply in recent weeks, partly because the third quarter earnings came in better than expected, partly because we're getting into a better seasonal period, partly because investors just got so negative, and then some other reasons we'll look at here shortly. But until proven otherwise, we still think the market is kind of in this wide trading range until something causes it to break out, hopefully to the upside and not to the downside. But we do think there's a chance for momentum into year end to continue. So, what else has pushed the market higher, particularly here in recent days where it's really kind of surged? Well, this week we had the latest inflation data, the US Consumer Price Index, and we see that it came in at about 3.2%. That's year over year. The monthly number was essentially flat month over month. So both of those were lower than expectations. The market liked that. They think it gives the Fed reason to be able to pause and stop raising rates, perhaps even next year talk about decreasing the Fed rates. So inflation is moderating. We think that longer term, it still settles in at a higher than historical rate. But as we look more at the shorter term, we actually think it can come down more. We've talked about the shelter CPI. This red line is a huge component of the CPI. Well, it's been very slow to come down, and it takes a while for this number to really track real time data. So, if we look at the blue, this is actually real time rent data out there for apartments. Not only is it obviously well off its highs, it's actually in some areas of the country, rents are actually declining on an absolute basis. So, I think this red number is going to be catching up in the months ahead. That should continue to offer some softening in inflation, perhaps offset by some other areas, but by and large, more good news than not on the inflation front. So, another thing that's been huge for the markets here of late and for the Fed is the job market. It continues to stay healthy. Yes, maybe softening in a few areas here and there, but this very long term chart shows us the consecutive number of months in blue that the unemployment rate has remained below 4%. So you can see now we're at the highest consecutive streak of low unemployment since going all the way back to the 1969-70 period. So job market remains healthy. That's good for the Fed. At the same time, inflation is moderating. That's also good for the Fed. Gives them ability to kind of stand aside, if not even cut things a little bit in the future. So, of course, in the backdrop of all this is interest rates. When the market was going down a few months ago, interest rates were going up. People were really concerned about that, understandably so. But here recently, particularly with the inflation data, interest rates have cooled off. They've pulled back quite a bit, particularly when you look at the longer term rates. And it's gotten a lot of investors to assuming that rates are just going to go back down quite a bit again. This is a fund manager survey over the last 20 years. It basically looks at what a fund manager is expecting rates to do, particularly longer term rates. You can see now a record number, about 60% of managers think rates will be lower next year. I mean, that may be the case, but usually when things are so one-sided, and if you go back and look at these other periods, their accuracy was not that great. So for us, we think that longer term decline in rates that happened for decades is over. Maybe we need to trade more sideways in rates for a while, but there will be periods like now when rates pull back. But by and large, I think investors should at least stay open-minded to rates continuing to move higher over time, or at least not decline too much. So wanted to keep it short this month, but in closing, stocks have been surprising to the upside due to positive earnings, better than expected, inflation coming in moderate, rates coming in, coming down. Seasonality's gotten better, and then sentiment. Investors have gotten really negative, and that really brings me to my last point. We try to remind you of this quite often, but really avoid the noise. I mean, honestly, keeping a longer term focus and avoiding all the short term noise out there will really help your financial state. It will help your mental state, all the above. So please try to keep a longer term focus. Well, we hope that everybody has a great Thanksgiving, and we will talk to you soon. Take care now.